Political power has long been associated with deception and dishonesty. But in the United States of America, where the people generally believe themselves to be informed, there has been perpetrated a fraud of such magnitude that it is without rival in history, and it continues to this day.
Every year in the United States, millions of Americans sign federal income tax returns, swearing under penalty of perjury that they owe federal income taxes. But the vast majority of those who sign such returns have never actually seen the tax laws, but instead have accepted on blind faith the conventional wisdom spread by the tax professionals and government officials, which says that the tax applies to the income of most Americans. That is not true. In time, the truth will become widely known, in spite of the so-called experts, when the people choose to examine the evidence for themselves. You are about to see that evidence. First, we will review the basics of federal law. All federal power originates with the Constitution of the United States of America. The Constitution authorizes Congress to pass laws regarding certain specific issues, such as patents, bankruptcies, and military matters, among others. Congress, through the legislative process, enacts laws relating to these matters, which are then encoded into the statutes of the United States Code. The United States Code is divided into 50 titles, with each title being a separate category of federal law. Title 26 is the federal tax title, often referred to as the Internal Revenue Code. Laws passed by Congress may add new sections, delete old sections, or change the wording of existing sections of the code. Though there have been many such amendments to the tax code over the years, the basic scope of the federal income tax has remained unchanged for many decades. But the statutes are not the end of the story. Congress, being the legislative branch of the federal government, writes the law, but the executive branch enforces the law. So Congress, by way of the statutes, authorizes various executive branch agencies to write regulations which express the agency's official interpretation of the statutes. In the case of income taxes, Congress delegates to the Secretary of the Treasury the power to write the regulations, which are binding on the IRS and, when published in the Federal Register, act as the official notice to the public of what the law requires of them. The wording of a statute and the wording of the regulations related to that statute are sometimes almost identical. However, the regulations are often more specific and give a more detailed explanation of the correct application of the law. All federal power must go through this chain of authority, from the Constitution to the statutes to the regulations. A regulation cannot require someone to do something unless Congress first enacts a statute requiring it. And before that can occur, the Constitution must grant to Congress the power to impose such a requirement. To fully understand the law, one must examine both the statutes and the related regulations. To simplify the process of understanding the federal income tax, we will begin with a hypothetical situation. Andy Green is a United States citizen who lives and works in Ohio. He does various jobs for his neighbors who pay him for his services. Our goal here is not to determine Andy's exact tax liability, but simply to determine if the federal income tax statutes and regulations show Andy Green's income to be taxable at all. While most people simply assume that their income is taxable, we will examine the evidence for ourselves. As stated before, Title 26 of the statutes, often called the Internal Revenue Code, deals with federal taxes. It is divided into several subtitles, which deal with different aspects of federal tax law. The first subtitle, Subtitle A, is where the income tax statutes are found. Subtitle A is divided into several chapters. Chapter 1 is where the basic federal income tax is found. The law will be represented in this graphic format to make the structure and content of the law more understandable. Chapter 1 of the Code is divided into many subchapters, but only a few of these are relevant to determining whether Andy Green's income is taxable. The first subchapter, titled Determination of Tax Liability, seems an obvious place to begin our search. The first part of that subchapter is titled Tax on Individuals, and the first section in that part, Section 1, is titled Tax Imposed. In that section, we quickly find that a tax is imposed on the taxable income of unmarried individuals, such as Andy Green. The section gives a chart for determining how much tax is due based on how much taxable income was received. But this section does not define taxable income. To learn what constitutes taxable income, we must look elsewhere. Subchapter B is entitled Computation of Taxable Income. The first part of Subchapter B looks promising, as it is entitled Definition of Gross Income, Adjusted Gross Income, Taxable Income, etc. And in that part we find Section 63, which is entitled Taxable Income Defined. The text of that section generally defines taxable income to mean gross income minus allowable deductions. So if Andy has gross income, he may be allowed to subtract certain deductions, and what's left over would be taxable income. Rather than just guessing at what gross income means, we want to see exactly how the law defines it. Nearby, we find Section 61, entitled Gross Income Defined. The section is quite short and generally defines gross income to mean all income from whatever source derived, and the first type of income it mentions is compensation for services, which is exactly what Andy receives when he gets paid for doing work for his neighbors. At this point, it seems as though Andy does receive gross income, and therefore taxable income as well. To be thorough, we will examine the regulations related to this section. The regulations give a similar definition, defining gross income to mean all income from whatever source derived, unless excluded by law. Andy wonders if the law somewhere might exclude his income. If Andy were to take the time to look at some of the nearby sections, he would find that certain types of income are specifically excluded from gross income. As one example, Section 101 says that certain life insurance proceeds are not considered gross income for purposes of the income tax. But try as he might, Andy will find nothing in those nearby sections which state that his income is not gross income. Again, Section 1 imposes the tax, and the regulations related to that section reiterate what we have found so far. They state that the tax is on taxable income, which is determined by subtracting allowable deductions from gross income. Further down, those regulations also state that citizens of the U.S., such as Andy Green, are liable for the tax whether the income is from sources within or without the United States. In Andy's case, all his income comes from inside the states. Everything we have seen up to this point seems to indicate that Andy's income is indeed taxable. The sections we have just examined are the same sections used by both IRS employees and tax professionals to determine whether the income of the average American is taxable. If we were to look no further into the law, the case would seem solid that Andy's income is taxable. But we will look further. The general public often has difficulty understanding the language of law, sometimes called legalese. Not only are sections of the law often complex and convoluted, but the actual words used in the law sometimes mean something entirely different from what the same words mean in common English. Without knowing the precise legal definitions of the words used in the law, it is very easy to get an incorrect impression of what the law requires. For example, in an area of Title 26 unrelated to income taxes, there is a section which says that the Secretary of the Treasury is to maintain a central registry of all firearms in the United States. However, several sections away, there is another section which defines the term firearm for purposes of that law. That legal definition bears little resemblance to the way the word firearm is used in common English. The legal definition includes, among other things, machine guns and short-barreled shotguns. However, the definition does not include the vast majority of revolvers, handguns, shotguns, and rifles, even semi-automatic military-style rifles. At the same time, the definition includes things which are certainly not usually called firearms, such as bombs and poison gas. The limited scope of this law is well known both to those in federal law enforcement and those in gun manufacturing. But if the average citizen were to examine this one section alone, he would almost certainly get an incorrect impression about the application of the law. Because of this aspect of legalese, the reader of the law must understand the precise legal meanings of the words used in the law. With this in mind, we return to the income tax statutes. To review, Section 1 imposes a tax on taxable income. Section 63 generally defines taxable income to mean gross income minus deductions, and Section 61 generally defines gross income to mean all income from whatever source derived. But could some words in this section mean something other than what they mean in basic English? To most people, the phrase "from whatever source derived" would seem to be synonymous with "no matter where it comes from." But what is the exact legal meaning of the term source? In each of the three main printed versions of the tax code, Section 61 has an interesting cross-reference. Regarding income from sources within the United States, the reader is directed to Section 861 of the statutes. The indexes of the code also refer to Section 861 and following regarding determination of sources of income, and specifically regarding income from sources within the United States, they refer to Section 861. While neither the cross-references nor the indexes are technically the law, they do give us an indication of where we should look next. The index of the Code of Federal Regulations, which does carry some legal weight due to the Federal Register Act, contains a similar entry. Under the heading Income Taxes, there is an entry concerning income from sources inside or outside U.S., as well as determination of sources of income, which refers the reader to the regulations under Section 861 and following. Section 861 is the first section in subchapter N of the statutes. As we saw before, the regulations related to Section 1 say that U.S. citizens are taxed on income from sources within or without the United States. The title of subchapter N is Tax Based on Income from Sources Within or Without the United States. Part 1 of subchapter N, which includes Section 861, is titled Determination of Sources of Income. An interesting fact about this title will be discussed later. We seem to be in the right place if we want to determine what legally constitutes sources of income. When we examine Section 861 itself, we find that it is titled Income from Sources Within the United States, which is not surprising in light of what we have just seen. The first subsection, 861A, is titled Gross Income from Sources Within United States, and the text of that section describes what shall be treated as income from sources within the United States. If the law defines what legally constitutes income from sources within the United States, one should not blindly assume he knows what that phrase means. Next, we drop down to the second subsection, 861B, which is entitled Taxable Income from Sources Within United States. In keeping with the general definitions of gross income and taxable income, Section 861B states that from the gross income from sources within the United States, described in 861A, certain deductions can be taken, and what's left over shall be included in full as taxable income from sources within the United States. At this point, it may be obvious that we are in the right place to determine Andy's taxable income from sources within the United States. However, it is necessary to reinforce this point because many tax professionals already know that these sections do not show Andy's income to be taxable. This is the part of the law which most tax professionals rarely examine, and when they do, they don't understand its significance. Before seeing what these sections show to be taxable, we must solidly prove that we are in the right place to determine Andy's taxable income, even though the tax professionals routinely disregard this section altogether. We now go to the related regulations, since the regulations often explain the law in more detail. The first section of related regulations is entitled Income from Sources Within the United States, and it describes the scope and purpose of Section 861 and following of the statutes. The very first sentence states that Part 1, which is Section 861 and following of Subchapter N of Chapter 1 of the Code and the regulations thereunder, determine the sources of income for purposes of the income tax. Gross income is generally defined as all income from whatever source derived, but these sections determine the sources of income for purposes of the income tax. Section 61 uses the term source, but these sections define what that term legally means. Compare this to the example regarding firearms. When the law uses the phrase all firearms, does that mean the reader is to ignore the legal definition of firearm? Of course not. The phrase simply means everything which falls within the legal meaning of firearm. Similarly, the meaning of all income from whatever source derived depends entirely on the legal meaning of the word source, and Section 861 and following and related regulations determine the sources of income for purposes of the income tax. Oddly enough, tax professionals and IRS employees rarely, if ever, examine this part of the law. But this sentence of the regulations, as significant as it is not all that the tax professionals misread or ignore. As we saw before, taxable income is generally defined in Section 63 to mean gross income minus certain deductions. But Section 861B specifically describes what constitutes taxable income from sources within the United States. As a matter of fact, anyone looking at the regulations under Section 63 for guidance in determining his taxable income will come up empty-handed. The regulations there just give a procedural rule about filing a tax return with itemized deductions versus using the standard deduction. They do not describe how to determine taxable income. After saying that these sections determine the sources of income for purposes of the income tax, the regulations explain that the statutes provide for 3 categories of income: income from sources within the United States, income from sources without or outside of the United States, and income which comes partly from inside and partly from outside of the United States. In Andy's case, we are only concerned with the first category. The regulations clearly state that gross income from sources within the United States consists of the income described in 861A and the related regulations. If one has income partly from within and partly from outside of the U.S., then Section 863 gives rules about how to divide up such income, some of which will then be treated as income from sources within the United States. But Andy Green has no such income, so 863 does not come into play for him. The regulations go on to say that the taxable income from sources within the United States shall be determined in accordance with Section 861B, and the reader is directed to the related regulations, which are found in Section 1.861-8. Again, if Andy had had income partly from within and partly from without the states, Section 863 could have come into play in determining taxable income from sources within the United States, but this was not the case. Though it's a bit redundant to do so, the regulations then make the point again, stating that taxable income from sources within the United States shall consist of the taxable income described in paragraph A1, which we just saw, plus in some cases income that comes partly from inside and partly from outside of the United States. In Andy's case, 861A and the related regulations determine whether he has gross income from sources within the United States, and 861B and the related regulations determine whether he has taxable income from sources within the United States. As we will see, these sections do not show Andy's income to be taxable. So why are the so-called tax experts telling most Americans that they owe federal income taxes? Like most people, tax professionals grew up hearing that almost everyone owes federal income taxes. Rather than starting with no assumptions and then studying the actual federal statutes and regulations to determine what is taxable, they got their information from publications, teachers, and textbooks, all of which simply echo the conventional wisdom that was passed on from prior generations. When a tax professional does examine the law itself, which does not happen nearly as often as one might expect, he is likely to simply dismiss any evidence which does not conform to his preconceived notions. It boils down to backwards thinking. Most start with the assumption that most income is taxable, and when they see that Section 861 does not show most income to be taxable, they conclude, based on a false premise and backwards logic, that they must be looking in the wrong place. They are simply unable to consider the possibility that the evidence means what it says and that conventional wisdom is incorrect. Section 1.861-8 of the regulations is what we were told to use for determining taxable income from sources within the United States. The first thing those regulations say is that Sections 861B and 863A state in general terms how to determine taxable income of a taxpayer from sources within the United States after gross income from sources within the United States has been determined. Then the regulations say that taxable income from sources outside of the United States is determined under Section 862, and in some cases 863 as well. Since Andy only has income from within the states, it is clear that he should use Section 861 and the related regulations to determine his gross income and taxable income. Again, the regulations under Section 1, the section which imposes the tax, told us that the tax is upon taxable income, and that U.S. citizens are taxed on their taxable income from sources within or without the United States. And the regulations under Section 863 specifically say that the taxpayer's taxable income from sources within or without the United States will be determined under the rules of Section 1.861-8 and following. And then they tell us yet again that those are the sections for determining taxable income from sources within the United States. The index of the regulations reinforces the point, referring to the regulations under Section 861 and following regarding income from sources inside or outside U.S. Keep in mind that in spite of all these citations, the so-called tax experts do not use these sections to determine taxable income from sources within the United States. They are either unaware of the citations we are looking at, or misread or ignore them. Now that we have abundant evidence showing that we are in the right place to determine Andy's taxable income, it's time to see what those sections actually show to be taxable. Again, the scenario is that Andy Green, as a U.S. citizen, performed a service within the 50 states and was compensated for it. Section 861 of the statutes states, "The following items of gross income shall be treated as income from sources within the United States." And on the list is compensation for labor or personal services performed in the United States. There are some unusual exceptions in the statute, but none applies to Andy. Even here, the law seems to include Andy's income. We now drop down to 861B for determining taxable income from sources within the United States. There, we are told that from the items of gross income in 861A, which includes compensation for services performed in the U.S., certain deductions can be taken, and the remainder, if any, shall be included in full as taxable income from sources within the United States. After coming all this way, it looks like Andy's income is taxable after all. Or at least, it looks that way at the moment. The key to understanding the federal income tax is understanding subchapter N of the Code, which is entitled Tax Based on Income from Sources Within or Without the United States. Section 61 lists some common items of income that can be taxable, but it says nothing about who is receiving the income or where it is coming from. As its title suggests, subchapter N spells out the circumstances under which those items of income are taxable when derived from inside the United States or when derived from outside of the United States. Before we study Part 1 more carefully, we will briefly look at the other parts of subchapter N. Part 2 deals with non-resident aliens and foreign corporations, and the first section thereof, Section 871, says that non-resident aliens who do business within the United States shall be taxable under Section 1 of the Code, which imposes the income tax on individuals. Here the statutes specifically identify this activity or type of commerce as being taxable. Section 882 says the same thing concerning foreign corporations doing business within the United States. Part 3 deals with income from outside of the United States. It includes sections about foreign tax credits, as well as Section 911, which deals with income earned by United States citizens living and working in foreign countries. It also includes rules about those who reside in or receive income from federal possessions, such as Guam and Puerto Rico. Part 4 gives special rules about domestic international sales corporations, and Part 5 deals with certain international boycott rules. It's plain that Parts 2 through 5 of subchapter N are all about international and foreign commerce, while those parts talk about the domestic income of foreigners and certain foreign income of U.S. citizens. They say nothing about the income of citizens who live and work exclusively within the 50 states. With that in mind, we will now examine Part 1 and the related regulations in more detail. As we already saw, Section 861 by itself, at first glance, appears to show most domestic income to be taxable. For example, the general wording of the statute seems to say that all compensation for services performed within the United States is taxable, with a few unusual exceptions. However, the proper scope of this section can only be understood in the context of the rest of subchapter N. Part 1 and its regulations determine the sources of income for purposes of the income tax. The sections therein give the general rules about determining taxable income from sources within the United States, from sources without the United States, and from sources partly within and partly without. But the regulations say that 861, 862, and 863 are for determining taxable income from specific sources. What could the phrase specific sources mean? Andy Green only has income from within the United States, and Section 1.861-8 is the section of the regulations we were repeatedly told to use for determining taxable income from sources within the United States. In the first paragraph of the section, it again mentions specific sources, saying that the rules of the section apply in determining taxable income from specific sources and activities, which are described in other sections of the code called operative sections. Section 871 is given as an example of an operative section. That section, as we saw before, states that non-resident aliens doing business in the U.S. shall be taxable under Section 1. The regulations direct us here for the complete list of operative sections which describe the specific sources and activities, income from which is taxable under Section 861. That list includes the foreign tax credit rules found in Section 901 and following. It includes the sections we saw before dealing with the domestic income of foreigners, and it includes certain rules relating to federal possessions, to foreign and international sales corporations, and to other foreign and international matters. But nowhere on the list of specific sources is anything which would include the income of a U.S. citizen who only has domestic income. The sections which determine the sources of income for purposes of the income tax only show income to be taxable when it comes from certain specific sources, which are all related to international and foreign commerce. The regulations reinforce the point another way. They say that a class of gross income consists of the items of income listed in Section 61, such as compensation for services, interest, rents, etc. The regulations then define statutory grouping of gross income to mean gross income from a specific source or activity, which must first be determined in order to arrive at taxable income from such a specific source or activity. So the items listed in Section 61 must come from a specific source or activity to be taxable. The regulations again point us to the list of specific sources in paragraph F1, which, as we have already seen, consists entirely of activities related to international and foreign commerce. These are the specific sources, income from which makes up the statutory groupings of gross income to which Section 1.861-8 is applicable. The section for determining taxable income from sources within the United States shows income to be taxable only when it derives from the specific sources and activities described in the various operative sections throughout subchapter N, which are listed together here in the regulations. The listed activities are all related to international and foreign commerce. Section 861 and its regulations are where we were sent to determine Andy's taxable income, and those sections do not show Andy's income to be taxable. Contrary to the misinformation spread by the IRS and the tax professionals, Andy's income is not taxable, according to the federal income tax statutes and regulations themselves. But how could this be? Surely it wasn't because Congress didn't want to tax Andy's income, so why didn't they? What was stopping them? As we saw before, the regulations generally define gross income to mean all income from whatever source derived, unless excluded by law. This last phrase has been almost universally misunderstood to mean that all income is taxable unless specifically exempted by some statute. But there is another type of law which can exempt income from taxation. According to the Supreme Court, it is elementary law that every statute is to be read in light of the Constitution, and that however broad and general its language, it cannot be interpreted as extending beyond the constitutional authority of the legislature writing the statute. The older regulations defining gross income began much as the current regulations do, stating that gross income means almost every type of income unless exempt from tax by law. But the older regulations elaborated on the concept. They said that certain types of income were exempted by statute, and went on to say that no other items are exempt from gross income except those items of income which are, under the Constitution, not taxable by the federal government. This was a clear admission that some income not specifically exempted by any statute was nonetheless exempted from taxation by the Constitution itself. The regulations back then defining net income, a phrase which would later become taxable income, reinforced the point, saying that neither income exempted by statute or by fundamental law, meaning the Constitution, are subject to the tax. This matches what the Supreme Court has said about the Constitution itself restricting the application of an otherwise broadly worded statute. This poses a problem for today's tax professionals, as they are unable to name any income which is not exempted by statute but which is exempted by the Constitution itself. While they may be able to name something constitutionally exempt, such as the income of state governments, such things are already exempted by the statutes, and this was already the case when these older regulations were written. But we cannot just guess at what is constitutionally taxable. The Secretary of the Treasury is the one authorized to write the regulations which tell how the statutes are to be interpreted. The older regulations answered the question about what is constitutionally taxable by saying that profits of citizens, residents, or domestic corporations derived from sales in foreign commerce must be included in their gross income. They also mentioned non-resident aliens and foreign corporations, and citizens and domestic corporations who receive income from within federal possessions, such as Puerto Rico. But no mention was made of citizens who receive all of their income from within the 50 states. This is a list of those types of commerce which the Secretary of the Treasury believed were, under the Constitution, taxable by the federal government. It matches subchapter N of the current code, which describes the types of commerce which Congress felt could be subject to a tax based on income from sources within or without the United States. It includes the domestic income of foreigners, certain foreign income of U.S. citizens, and certain rules regarding international sales corporations and rules about federal possessions. Anyone who doubts that this is an exclusive list of the types of activities which are taxable runs into several logical problems. First, these activities are not mentioned at all in the statute defining gross income, so why do the regulations mention them? If this is not an exclusive list of what is constitutionally taxable, why are these activities mentioned at all? And why would the regulations specifically say that citizens must include certain foreign income while never saying they must include their domestic income? Also, if this is not the answer to the question about what is constitutionally taxable, then the regulations never answer the question. Nothing else in these regulations even comes close to saying what is or is not constitutionally taxable. The regulations must give specifics. They must tell the public precisely what the law requires, and they did. But why would this be all that is constitutionally taxable? Why these activities, and why not the income of most Americans? The Constitution created a federal government of enumerated powers. The powers delegated by the Constitution to the federal government are few and defined. Article 1, Section 8 of the Constitution lists all of Congress's powers within the 50 states. In this particular case, the Supreme Court threw out the original gun-free school zone law, saying it was beyond the authority granted to Congress by the Constitution. The Constitution empowers Congress to write laws concerning things such as currency, bankruptcy, immigration, patents, military matters, and a few others. The 10th Amendment states that all powers not specifically granted to Congress belong to the state governments or to the people. Congress is granted the power to regulate commerce which crosses state lines and commerce with foreign countries. However, when it comes to matters happening inside one of the states, Congress often has no power at all. In the words of an old Supreme Court ruling, no interference by Congress with the business of citizens transacted within a state is warranted by the Constitution, except such as is strictly incidental to the exercise of powers clearly granted to the legislature. So how could Congress tax the income of most Americans? Article 1, Section 8 does say that Congress has the power to lay and collect taxes. Though certain rules are given for what are called direct and indirect taxes, nothing is said about exactly what can be taxed by Congress, except one clause forbidding taxes on state exports. It is easy for people to misconstrue this to mean that Congress can tax anything it pleases within the 50 states, but this is not true. Consider the case we just saw. If Congress could not directly forbid the possession of a gun near a school within the 50 states, could they instead impose a $1 million tax on possessing a gun near a school to accomplish the same goal? No. Though the taxing clause itself does not specifically forbid it, if such a trick were allowed, Congress could control whatever it wanted to, as long as it did it by way of tax legislation. The Supreme Court has addressed this very issue. Many years ago, after the court stated that Congress has no constitutional authority to outlaw child labor within the 50 states, Congress attempted to combat such practices by taxing them out of existence. The Supreme Court threw out the tax, saying that if it allowed the tax to stand, all that Congress would need to do to gain control over all sorts of new matters, jurisdiction of which the states have never parted with, and which are reserved to the states by the 10th Amendment, would be to enact a detailed measure of complete regulation of the matter and enforce it by a so-called tax upon departures from it. The Supreme Court said that to give such magic to the word tax would be to break down all constitutional limitation of the powers of Congress. The court made it quite clear that the very nature of the Constitution creates certain virtual limitations on the taxing power, in addition to the specific limits mentioned. So how does this principle apply to an income tax? Imagine Congress trying to pass the following law. This law would require everyone in the 50 states who receives income to submit his personal financial records to agents of the federal government. In addition, this law would punish some behaviors and sanction others, even though those behaviors have nothing to do with anything under federal jurisdiction. For example, suppose this law punished people for earning more money, or being self-employed, or being married, but would also reward people for having a mortgage, having a college tuition, using an electric car, etc. In the specific powers granted by the Constitution, there is no authority for Congress to do any of these things. But if we are to believe the conventional wisdom about the income tax, then Congress did all of these things and more by way of the tax code. Could Congress acquire jurisdiction over all these things just by making the law in the form of a tax? No. To give such magic to the word tax would be to break down all constitutional limitation of the powers of Congress. As we have seen, the income tax applies only to those engaged in certain types of international or foreign commerce. In one case, the Supreme Court specifically addressed how the 1913 income tax affected an American company which would ship its goods to foreign countries and sell them there. The court stated that because the Constitution empowers Congress not only to lay and collect taxes, but also to regulate commerce with foreign nations, Congress therefore undoubtedly had the power to tax the company's profits from such commerce. The statutes and regulations prove that the income tax applies only to income derived from commerce with foreign nations, such as foreigners getting income from within the United States and U.S. citizens getting foreign income. Because only those engaged in some form of international or foreign commerce are taxed, only they are subject to the requirements, rewards, and punishments in the tax code. Congress is merely regulating matters that are under its jurisdiction. Brief mention should be made of the 16th Amendment, since some claim that it authorized the tax on the income of all Americans. According to both the Supreme Court and the Secretary of the Treasury, the 16th Amendment conferred no new powers of taxation, but simply confirmed that the income tax inherently belongs in the category of indirect taxes, which never required apportionment, which is a process where a tax has to be divided up among the states according to populations. The broad wording of the amendment talks about the power to tax incomes from whatever source derived, but that does not, for example, mean that Congress can tax the income of everyone in China. That example alone proves that the 16th Amendment has to be read in the context of the rest of the Constitution. The Supreme Court made it quite clear that the amendment did not extend the taxing power to new or accepted subjects, and long after the 16th Amendment was written, the regulations showed that some types of income were still, under the Constitution, not taxable by the federal government. Those regulations went on to say that income from certain types of international and foreign commerce must be included as gross income. Though the income tax statutes and regulations are more complicated than most federal law, the general structure of the income tax is not unique. Often a federal law will describe a legal requirement in general terms in one section, while other sections show that the requirement applies only to those engaged in commerce which is under federal jurisdiction. For example, one section of the federal anti-discrimination laws makes it unlawful for any employer to discriminate against someone based on age. However, other sections show that the term employer, for purposes of that law, includes only those whose business affects certain commerce which is under federal jurisdiction, such as interstate or international commerce, or commerce within federal possessions. Similar limits exist in many other federal laws. Likewise, while Section 61 gives a broadly worded definition which by itself seems to show most income to be taxable, Subchapter N of the statutes specifies in which situations income from within or without the United States is subject to the tax. As with other federal laws, the tax only applies to those engaged in commerce which is under federal jurisdiction. It is true that the federal courts have continually stretched their reading of the Constitution, upholding laws which the courts previously would have rejected as unconstitutional. But even if some federal judges might now claim that Congress would have the power to tax the income of all Americans, such an opinion would be irrelevant, because the law itself shows what Congress did tax, which was primarily international commerce. The limits on Congress's taxing power are brought up not to argue about the constitutionality of the law, but only to show why the statutes and regulations say what they say. Though the federal income tax was widely misunderstood from the beginning, the statutes and regulations have contained the truth for many decades. But an attempt to cover up the truth becomes apparent when one studies the changes that have occurred over the years to two particular sections of the law: the section generally defining gross income, now found in Section 61, and the section dealing specifically with income from sources within the United States, now found in Section 861. In 1939, the statute generally defining gross income used broad wording which seemed to imply that most income was taxable. However, the related regulations showed that some types of income not exempted by any statute were nonetheless exempted by the Constitution itself. The regulations then identified what is constitutionally taxable by saying that income which Americans receive from foreign commerce must be included as gross income, in addition to the domestic income of foreigners and certain income of those doing business in federal possessions. In 1954, the tax code was rearranged and renumbered, and the basic structure has remained the same since. Since then, the regulations under Section 61 have generally defined gross income to mean all income from whatever source derived, unless excluded by law. But they no longer explain that excluded by law means excluded by statute or excluded by the Constitution itself. In addition, these new regulations no longer list those types of commerce, income from which must be included as gross income. That list does still exist, but is now in the regulations under Section 861. Those regulations say that classes of gross income consist of the items of income listed in Section 61, such as compensation, income from business, interest, etc. The regulations then refer the reader to another part of the section, which provides that a class of gross income may include excluded income. This is a slightly twisted way of saying that the items in Section 61 are not always taxable, but are sometimes excluded by law. The regulations lead to this section, which defines exempt income to mean income which is exempt, excluded, or eliminated for federal income tax purposes. The section then gives a list of those types of income which are not exempt. If the items of income listed in Section 61 come from these types of commerce, they are subject to the tax. The list, though worded differently, is basically the same list found in the older regulations defining gross income. The list includes certain foreign income of Americans, the domestic income of foreigners, and certain rules about those doing business in federal possessions. Like the older regulations, it does not include the income of the average American. Most tax professionals have never even seen this section, and those who have cannot explain it. They don't know why the regulations say that the items in Section 61 are sometimes excluded, because they don't realize that the Constitution itself exempts some income. They also cannot explain the purpose of this list of non-exempt income, and they cannot explain why the income of the average American is not on the list. This route to the truth, dealing with the issue of exempt income, independently leads to the same conclusion that we reached before when studying the specific rules for determining taxable income from sources within the United States, which was that only income from certain types of international and foreign commerce are taxable, including the domestic income of foreigners and foreign income of Americans. While the older regulations defining gross income by themselves told the whole truth about which income was taxable, back then the truth was reinforced further by the statutes giving a direct link between the general definition of gross income and the specific rules about income from sources within the United States. In the older statutes, Section 22 dealt with the general definition of gross income, and 22G told the reader that, for computation of gross income from sources within and without the United States, they were to refer to Section 119, which would later become Section 861 and following. After 1954, this link vanished from the statutes, making it very unlikely that the average reader would look at Section 861 at all. To learn the history of Section 861 itself, we roll back the clock to 1925. Back then, this section of the law was only 4 section numbers away from the general definition of gross income. It said that, in the case of non-resident aliens and citizens entitled to the benefits of Section 262, certain kinds of income were to be treated as income from sources within the United States. First, we must see who was entitled to the benefits of Section 262. Under that section, citizens who received most of their income from federal possessions, such as Guam or Puerto Rico, were taxed only on their income from the 50 states, but not on their income from the possessions. As an aside, this section made it possible, though unusual, for U.S. citizens to have taxable income from within the United States, therefore allowing Section 1.1-1 to truthfully say that citizens are taxed on their taxable income whether from sources within or without the United States. only those receiving income from federal possessions were entitled to the benefits of Section 262. Therefore, according to Section 217, in the case of non-resident aliens, and in the case of citizens who receive most of their income from federal possessions, certain types of income, such as interest from the U.S. and compensation for services performed in the U.S., were to be treated as income from sources within the United States, and after subtracting deductions, were to be included in full as net income, or taxable income, from sources within the United States. 3 distinct criteria had to be met in order for income to be taxable under this section. First, one had to be engaged in a certain activity, namely a non-resident alien getting income from the U.S., or a citizen getting income from federal possessions. Back then, another section of the statutes showed that the rules in Section 217 also applied to foreign corporations and domestic corporations with possessions income, so we will add those to the list of specific activities. The second criteria was that some item of income was received, such as interest, dividends, compensation, etc. The third criteria was that the income came from inside the U.S. Only when all 3 applied did the section show income to be taxable. While one might wonder what other sections might say, it is absolutely clear that this section did not say that the domestic income of most Americans was taxable. It said that for foreigners, and for certain Americans who also receive income from federal possessions, income from within the United States was taxable. There is a principle of law which, translated from the Latin, roughly means the inclusion of one implies the exclusion of all others. When a law specifically says that it covers certain matters, it is to be assumed that it does not cover all the things which are not specifically mentioned. For example, when the older statutes specifically said that domestic income was taxable for foreigners and for citizens who also received possessions income, it is a mistake to assume that it is taxable for all other U.S. citizens as well. As the Supreme Court said, in the interpretation of statutes levying taxes, it is the established rule not to extend their provisions by implication beyond the clear import of the language used, or to enlarge their operation so as to embrace matters not specifically pointed out. The court also added that in case of doubt, taxing statutes are to be construed most strongly against the government and in favor of the citizen. Moving forward to 1939, we see that this section remained basically the same, except that the first phrase simply vanished. The section no longer said that it was only about foreigners and Americans who receive possessions income. It now seemed to say that all income from inside the U.S. was taxable. Was this a drastic change in the application of the law? Had all domestic income become taxable for everyone? No. While the statute no longer mentioned the specific activities, the related regulation still began by saying that the section was about non-resident aliens, foreign corporations, and U.S. citizens and domestic corporations receiving income from federal possessions. The statutes talked about items of income and the geographical origin of the income, but numerous sections of the regulations still showed that domestic income was only taxable for those engaged in specific activities described in other sections of the code, now called operative sections. For example, the general wording of the statute seemed to say that all interest from the United States constituted gross income, but the related regulations clearly stated that interest from the United States was to be included as gross income when received by non-resident aliens, foreign corporations, and Americans who also receive possessions income. The regulations about taking deductions and determining taxable income also were plainly only about those engaged in these specific activities. As the years went by, the sections of regulations showing the truth began vanishing from the law books. But bits of truth still remained in 1954 when the code was renumbered and rearranged. The old Section 119 became Section 861 and following, which have remained essentially the same since. Congress specifically said that the application of this section did not significantly change in 1954, but there were significant changes in the wording of the related regulations. Perhaps the most significant change occurred in what is now Section 1.861-8, the section for determining taxable income from sources within the United States. The older regulation said that from the items of income listed in preceding sections, which constitute income from sources within the United States, there shall, in the case of non-resident aliens and foreign corporations doing business within the United States, be deducted allowable deductions, and the remainder was to be included in full as net income from sources within the United States. The section also included an example showing how a non-resident alien would compute his taxable income. When this section became Section 1.861-8, most of it remained the same. However, the phrase saying exactly who it was about simply vanished. It now said that from the items described in preceding sections, which constitute income from sources within the United States, certain deductions were to be subtracted, and the remainder was to be included in full as taxable income from sources within the United States. It no longer admitted to whom it actually applied. In addition, the example used in the section was identical to the example in the older regulations, except that instead of referring to a non-resident alien doing business in the United States, it simply referred to a taxpayer. All the numbers stayed the same, but the wording was changed in a way that would seem to imply that the domestic income of everyone is taxable. Again, Congress specifically said that the legal application of this section had not changed significantly. So why were these regulations changed? An equally conspicuous change occurred in the section regarding interest from the United States. The older regulations clearly said that interest from the United States was to be included in the gross income of non-resident aliens, foreign corporations, and those who receive most of their income from federal possessions. After 1954, the text of the regulation remained exactly the same, word for word, except for the phrase saying who must include domestic interest as gross income, which simply disappeared from the section. Now the section seemed to say that interest from the U.S. always constituted taxable gross income. Since the correct application of the law did not change, this rewording can only be explained by a premeditated attempt to mislead the reader. It is undeniable that Section 217 in 1925 only said that domestic income was taxable for non-resident aliens, foreign corporations, and United States individuals and corporations who also received income from federal possessions. Since the correct application of this section has not changed since then, what purpose was served by all the subsequent changes to the wording of the statutes and regulations, except to hide the truth about who could actually have taxable income from sources within the United States? To review, here is what the law told us in 1939. The statute defining gross income gave a broadly worded general definition, but the related regulations showed that some income not exempted by any statute was nonetheless excluded by the Constitution itself. The regulations then specifically listed those types of commerce which were not exempt: certain foreign income of Americans, the domestic income of foreigners, and the domestic income of Americans who also had possessions income. In addition, the statute defining gross income said that for computing gross income from sources within and without the United States, one should refer to Section 119, the predecessor of Section 861 and following. This was a clear, direct link between the general definition of gross income and the specific rules about income from sources within and without the United States. Back in 1939, Section 119 of the statutes gave rules about the geographical origin of income, describing how to determine whether income was to be considered as coming from inside of or outside of the United States. The related regulations then specifically and repeatedly described those situations in which income from within the United States was taxable, namely for foreigners and for Americans who also had income from federal possessions. This matches exactly what the 1925 statute showed as well. Note that in 1939, the regulations generally defining gross income and the specific rules about income from within the United States both said that domestic income was taxable for foreigners and for Americans who also received possessions income. After 1954, the statute still gave a broadly worded general definition of gross income, but the related regulations no longer mention the Constitution, nor did they mention the specific types of commerce, income from which was taxable. In addition, the link to what is now Section 861 was removed from the statutes. It exists now only in the form of the cross-references under Section 61 put in by the printers of the code. In addition, after 1954, the rules about income from within and without still gave rules about the geographical origin of income, but the regulations no longer mentioned that income from the U.S. was only taxable for those involved in specific activities. In both the statutes and regulations, the truth had been purged from the law books, even though Congress said the application of these sections had not changed. Only later did the truth return to the regulations under Section 861, which is now the only place the truth is found, both the truth about which income is exempt and the truth about which income from within the United States is taxable. But just after 1954, the truth was virtually impossible to find, unless the reader was aware of the history of the sections and the scope and purpose of Subchapter N. The title of Section 1.861-8 was then Computation of Taxable Income from Sources Within the United States. It seemed an obvious place for people to look to determine their taxable domestic income, but if the average American did look there, he would most likely incorrectly conclude that his income was taxable. In 1978, this title was expanded to read Computation of Taxable Income from Sources Within the United States and from Other Sources and Activities. Based on that title, some now claim that one should only refer to this section if he has both domestic and foreign income, though numerous citations prove that to be incorrect. In addition to the title change, the text of the section went from less than 1 page to over 30 pages, with no significant change in the statutes to justify it. Along with the explosion in the size of the section, a host of new legalese phrases appeared, including specific sources, operative sections, statutory groupings, etc. In the midst of this new maze, the list of taxable activities was inserted under the inconspicuous heading Miscellaneous Matters. But again, aside from various new rules about foreign tax credits and international sales corporations, the list is about foreigners and those who receive income from federal possessions. Anyone struggling through the 30-some pages of the current 1.861-8 and comparing it to the older regulations would be hard-pressed to find any honest motive for these changes. They certainly don't clarify anything, and there was no change in the statutes making such an expansion necessary. Instead, the change seemed designed to confuse the reader. Later, in 1988, the title of Part 1 of Subchapter N, as it appears in the Government Printing Office version of the code, was changed from Determination of Sources of Income to Source Rules and Other General Rules Relating to Foreign Income. The text of these sections had not significantly changed, and the law says that titles of parts carry no legal weight, So why change the title? Again, coming up with an honest explanation is difficult, but a deceptive motive is readily apparent when we examine the table of contents of the law before and after this change. Because gross income is generally defined as all income from whatever source derived, the table of contents prior to 1988 laid out a fairly obvious path to Section 861. Subchapter N was about tax based on income from sources within or without the United States. Part 1 was about determination of sources of income. Section 861 was about income from sources within the United States, and Section 861B was about taxable income from sources within the United States. The trail to 861B was rather obvious, but with the title of Part 1 changed, the average U.S. citizen was likely to conclude that he shouldn't be looking there, since the new title, read one way, implied that it was only about foreign income. Interestingly, the United States Code Service printing of the code, which more faithfully adheres to the underlying law, the statutes at large, still has the title of Part 1 appearing as Determination of Sources of Income. So the correct title is somewhat debatable, but ultimately irrelevant since such titles do not carry any legal weight. After 1954, the sections defining gross income no longer told the whole truth, but simply defined the term to mean all income from whatever source derived, while the regulations under Section 861 began to say that 861 and following and related regulations determine the sources of income for purposes of the income tax. In essence, the truth had been relocated so that Section 61 itself and its regulations no longer contained even a hint about the limited nature of the tax. And while the current regulations under Section 861 do contain the truth, they further confuse the issue by using the term source to mean geographical origin in some places and to mean specific activities or types of commerce in other places. Section 861 and following give the general source rules concerning income from within and without the United States, but those general rules only show income to be taxable when derived from specific sources, and in that usage, the word source means certain activities or types of commerce. This adds confusion and makes it even more likely that most Americans would ignore these sections entirely, thinking that only someone who had a question about the geographical origin of his income needed to refer to those sections, being unaware that the word source might mean something else. This simple summary cuts through the confusion. Section 861B and the related regulations in Section 1.861-8 are the sections to use for determining one's taxable income from sources within the United States. And as decades of statutes and regulations prove beyond any doubt, those sections do not show the income of most Americans to be taxable. The truth is still there to be found, although one must now unravel a tangled maze to find it. Looking at it objectively, it is difficult to explain why this complicated and convoluted web of legalese exists at all, if not to hide the truth. All the evidence points to an intent to deceive. Given what we now know about the statutes and regulations, past and present, we will consider a few sample transactions and determine if the income from those transactions is subject to the federal income tax. In our first scenario, a Canadian citizen, a non-resident alien with respect to the U.S., doing business within the United States, has some money in an American bank, and that bank pays interest to him. Section 61 of the Code generally defines gross income as all income from whatever source derived, including interest. So interest is the item of income. Next, we look at Section 861 and following and the regulations thereunder, which determine the sources of income for purposes of the income tax. The general terms of Section 861 seem to say that this income shall be treated as income from sources within the United States, but the general terms of Section 861 are for determining taxable income from specific sources. Looking at the section of regulations for determining taxable income from sources within the United States, we see that it only shows income to be taxable when it derives from one of the specific sources or activities which are listed here. The list includes non-resident aliens doing business within the United States. This activity is described in Section 871b1 of the statutes, a so-called operative section. Subchapter N of the Code is where Congress has designated which activities are subject to tax based on income from sources within or without the United States. Section 871 clearly confirms that a non-resident alien engaged in trade or business within the United States shall be taxable under Section 1, which imposes the income tax on individuals. The statutes and regulations confirm that a taxable item was received, in this case interest, and that it derived from a taxable activity or source, in this case a non-resident alien doing business within the United States. Just to double check it, we will approach it another way. The regulations say that the items of income listed in Section 61, including interest, make up classes of gross income, which may include income which is excluded for federal income tax purposes. We are directed here to find out what income is exempt, and in the list of non-exempt income, income which is subject to the tax, we see included effectively connected income of foreign taxpayers, meaning income related to foreigners doing business within the states. To confirm it one step further, we review the older regulations defining gross income, and they mention the domestic income of non-resident aliens. The predecessor statute to Section 861 confirms everything we have found for this scenario. In the case of a non-resident alien, interest from within the United States legally constitutes income from sources within the United States, and after allowable deductions, the remainder shall be included in full as taxable income. Under the Constitution, Congress has jurisdiction over commerce with foreign nations, which would include this transaction. The Constitution, the statutes, and the regulations all agree this transaction is taxable. Our second scenario involves Andy Green's cousin, Susie, who is also a United States citizen, but she resides in Canada, where she works for a Canadian corporation which pays her for her services. Looking at the list in Section 61, we see that compensation for services is a taxable item. Looking at Section 862, we see that compensation for services performed outside of the United States, such as is the case here, is to be treated as income from sources without the United States. But then we look to the statutes of subchapter N to see if this particular activity is described. In Section 911, we find that Susie, as a United States citizen living abroad, is entitled to a large exemption, but that after that her foreign earned income is taxable. Again, we will approach it another way. The regulations say that the items of income listed in Section 61, including compensation for services, make up classes of gross income, which may include exempt or excluded income. Again, we are directed here to find out what income is exempt, and we see that the foreign earned income of U.S. citizens, as defined in Section 911, is not exempt from taxation. If we review the older regulations defining gross income, we see that income of U.S. citizens from foreign commerce must be included in their gross income. As we saw previously, the Supreme Court ruled that because Congress has the general power to lay and collect taxes, and the power to regulate commerce with foreign nations, they therefore undoubtedly have the power to tax income which Americans receive from foreign commerce. This transaction is taxable. It includes a taxable item, compensation for services, derived from a taxable activity or source, a U.S. citizen living and working abroad. While IRS publications and forms carry no legal weight, even they sometimes make some interesting admissions. The instruction booklet for the Form 1040, for example, when discussing the reporting of income on the return, shows that citizens are required to report items of income received from foreign sources. The booklet then describes on which lines to report the various items. Most Americans merely assume that the items they receive also must be reported, though the instruction booklet never actually says so. Similarly, IRS Publication 525, which is entitled Taxable and Non-Taxable Income, states that if you are a U.S. citizen, you must report income from sources outside the United States. The rest of the publication then addresses which items can be taxable. Again, most readers assume they must also report those items of income if they come from within the states, but the publication never actually says so. So while most Americans are assuming that their income is taxable, Susie is specifically told in the forms, publications, statutes, and regulations that her income is to be included as taxable gross income. For our third scenario, a Canadian citizen receives a dividend from the same Canadian corporation that Susie works for. Section 61 lists dividends as a taxable item. Section 862 states that dividends from outside of the U.S. are to be treated as income from sources without the United States. But we then look to subchapter N to see if Congress has designated this specific activity as being taxable. They have not. The Constitution obviously did not give Congress the power to tax foreigners doing business in their own country, and the federal income tax statutes and regulations, past and present, show that this income is excluded for federal income tax purposes. Though a taxable item was received, it was not derived from a taxable source or activity, and therefore is not taxable. For our fourth scenario, we consider what happens when a foreign corporation receives profits from doing business with a domestic corporation. To run through it quickly, the item of income is taxable, and it derives from a taxable activity described in the operative sections of subchapter N, which the regulations list as a specific source which is taxable. Where the regulations describe in which circumstances the items of income are exempt, the domestic income of foreigners is shown to be taxable, and the same holds true in the older regulations. For our fifth scenario, Andy has saved up some money in an American bank, and the bank pays him interest on that money. As we have already seen, Section 61 does include interest as a taxable item, but then we examine Section 861 and following, and the regulations thereunder, since they determine the sources of income for purposes of the income tax. The general terms of Section 861 say that such interest shall be treated as income from sources within the United States, but these general terms only apply in determining taxable income from the specific sources. Looking at the section of regulations for determining taxable income from sources within the United States, we see that it only shows income to be taxable when it derives from one of the specific sources or activities listed here. And here we do not see any specific source which applies to this situation. In addition, looking in the statutes of subchapter N, where Congress has designated which activities are subject to tax based on income from sources within or without the United States, we find nothing at all which would show this type of commerce to be taxable. To look at it another way, the regulations say that the items of income listed in Section 61 may include income which is excluded for federal income tax purposes. The list of the types of commerce which are not exempt but which are instead subject to the tax, does not include the interest Andy received from the bank. The older regulations do not list this income as having to be included in Andy's gross income. In fact, the older regulations specifically say that interest received from within the United States shall be included in the gross income of non-resident aliens, foreign corporations, and U.S. citizens and domestic corporations who receive most of their income from federal possessions. It says nothing about the interest Andy receives having to be included as gross income. Congress, in one part of the law, listed the taxable items of income, including interest, but in the portion of the law which spells out which specific activities or types of commerce are taxable, there is no mention at all of Andy's situation. Again, the Supreme Court states that we are not to assume that the law covers matters not specifically pointed out. In this case, a taxable item was received, but it did not derive from any of the sources of income for purposes of the income tax, and is therefore excluded for federal income tax purposes. But some were hoping that Andy would never know this. What we have just examined is not all of the evidence showing the truth about the limited nature of the federal income tax, or all of the evidence showing the efforts to conceal that truth. While some in government did conspire to deceive and defraud the American public, this deception has continued not because of mass secrecy, but because of mass ignorance. The ignorance of IRS employees, the ignorance of the tax professionals, and the ignorance of the general public. Ironically, for decades some have tried to fight against the tax using various dubious theories and legal arguments, because these so-called tax protesters were also ignorant about what the law itself actually says. The problem is not the law itself, but the misrepresentation and misapplication of the law. Millions of Americans have been defrauded, extorted, harassed, threatened, and prosecuted, all based on a deception that the enforcers themselves, for the most part, did not understand. A falsehood this long-lived, this universally accepted, and of this magnitude, has tremendous staying power. Human psychology being what it is, many people would rather cling to their long-held but erroneous beliefs than face the ugly truth as it sits in front of them. Throughout history, the experts and the public have often clung to incorrect common knowledge until uncomfortably forced to face the cold, hard evidence. The truth, though sometimes unpleasant, is better than a lie, and the truth is that some individuals inside the United States government orchestrated and successfully executed the most massive fraud and extortion racket in the history of mankind. What the people will do about it remains to be seen.